You've shared a truly compelling set of information about Tesla. And it's clear you're not looking for surface level news. You want to understand the core drivers,
Mm-hmm.
the real story behind the headlines.
Right.
So let's not waste any time. We're diving deep into a recent Morningstar report on Tesla Inc. Think of this as your shortcut to understanding their current stock valuation, their overarching business strategy, the intense competition they face, and what the future might realistically look like, especially with those potential U.S. tariffs adding a new layer of complexity.
Exactly. You've given us a comprehensive equity research report packed with analyst notes on everything from the potential impact of those tariffs to the CEO's latest strategic pronouncements and even the recent Cybertruck recall.
Hmm.
Our mission is straightforward: to get under the hood of Tesla's current market value, pinpoint their true competitive strengths and weaknesses in this dynamic industry, and identify the crucial factors that will dictate their performance as the automotive and technology landscapes continue to evolve.
All right, let's get right to it. Tesla's stock price, as of March 26, 2025, was sitting at $272.06. Now, that number on its own doesn't tell us much, does it?
Not really, no. What's more telling is when we compare that to Morningstar's assessment of what they think Tesla is actually worth their fair value estimate.
Okay.
That was last updated on January 30th, 2025, and they came up with $250.
Ah, okay.
So if you do the math, that gives us a price to fair value ratio of 1.09. Essentially, the market was valuing Tesla about 9% higher than Morningstar's intrinsic value estimate at that point.
And the market capitalization, the total value of all their outstanding shares, that's a massive $875.09 billion. Just huge. Now, Morningstar also gives the stock a rating. As of March 2025, it's a 3-star rating. What should you make of that?
Well, a 3-star rating is right in the middle of Morningstar scale. It suggests that, based on their analysis, the stock is trading around its fair value. It's neither significantly overvalued nor undervalued. What's particularly interesting, though, and something you can see in the report's appendix, is how that rating has fluctuated over time.
Hmm.
It really gives you a sense of the market's changing confidence and perspective on Tesla's prospects.
Context is everything, isn't it? Now, one of the more immediate factors that could influence that valuation are these potential U.S. tariffs, a 25% levy on automobiles and auto parts with non-U.S. content announced by President Trump. How does Tesla, with its U.S. manufacturing focus, stand in the face of this?
This is where it gets really interesting. According to the analyst note from March 27th, 2025, these proposed tariffs are actually viewed as a slight positive for Tesla.
Oh, really? How so?
Because they manufacture the vast majority of the vehicles they sell in the U.S. domestically, their competitors, who often rely more heavily on imported vehicles and parts, are likely to face a more significant increase in their costs.
So a potential tailwind for Tesla, at least on the surface, but surely they're not completely immune to these tariffs.
You're right, it's not all upside. While their U.S.-assembled vehicles gain a relative advantage, Tesla still imports a considerable amount of auto parts and essential raw materials like steel and aluminum.
Right.
These imported components will be subject to the new tariffs, which will inevitably lead to higher production costs for Tesla as well.
A double-edged sword, then. But despite this, Morningstar has maintained its $250 fair value estimate. That seems to suggest they believe Tesla can weather this storm of increased costs. What's the thinking there?
It likely reflects Morningstar's belief that Tesla has enough levers to pull, perhaps absorbing some of the cost increases or, strategically passing some on to consumers while still maintaining a competitive pricing advantage, especially given the potentially larger cost burden on their competitors who import more finished vehicles.
Okay, so that's the near-term tariff situation. But let's step back and look at the bigger picture, Tesla's overall business strategy and where they see themselves heading. They're not just a car company anymore, are they?
Not at all. What's fascinating here is how Tesla has positioned itself not just as a leading electric vehicle manufacturer, but also as a major player in autonomous driving software development. Their current vehicle lineup covers a wide spectrum, from the high-end Model S and X to the more accessible Model 3 and Y, and now they've branched out into the truck segment with the Cybertruck and the Semi.
Right, the Cybertruck.
And looking forward, their ambitions are huge, with plans for a more affordable SUV, a high-performance luxury sports car, and, of course, the much-anticipated robotaxi network.
And their goals for dominating the EV market are pretty ambitious, if I remember correctly.
Absolutely. They're aiming to solidify their position as the dominant force as electric vehicles continue their rapid growth. Morningstar's projections actually align with this trend, anticipating that EVs will account for roughly 40% of all global auto sales by the year 2030.
Wow, 40%.
Yeah. To capitalize on this explosive growth, Tesla has been pouring significant investments into building new gigafactories and into research and development, around 4% of their total sales, actually.
Okay.
This R&D is focused on both pushing the boundaries of their technology and achieving a dramatic reduction in their manufacturing costs, with a long-term goal of cutting those costs by over 50%. That's a staggering target.
50% is a massive undertaking. How do they even aim to achieve such a drastic cost reduction?
Their strategy hinges on a few key pillars. Firstly, relentless pursuit of automation and efficiency in their production processes. Things like simplifying vehicle design to reduce the number of parts needed.
Makes sense.
Secondly, they're heavily invested in vertically integrating their battery production, designing and manufacturing some of their own battery cells and packs. This gives them greater control over costs and performance, and it's seen as crucial to reaching that elusive cost parity with traditional gasoline-powered vehicles.
Right, the battery tech is central.
Definitely. And of course, we can't forget the continued expansion of their supercharger network, which is a vital piece of the puzzle for making EV ownership convenient and appealing to a wider audience.
It feels like Tesla is trying to create this self-contained ecosystem for their customers, going way beyond just the initial car purchase.
That's a crucial insight. They're definitely aiming to capture a larger share of their customers' ongoing spending. Think about it. Their autonomous driving software subscriptions, their own insurance offerings, and, naturally, the revenue generated through their supercharging network.
Mm-hmm.
And then there's the planned robotaxi service, which Morningstar believes could potentially capture a massive slice, perhaps as much as 50% of the U.S. and Canadian ride-hailing market by 2030.
50%. Wow.
Plus, they have their energy division, with solar panels and battery storage solutions for both residential and utility-scale customers, further diversifying their revenue streams beyond just selling vehicles.
So that paints a pretty optimistic picture for Tesla's future.
Yeah.
What are the core arguments that the bulls in this report are highlighting? What's the best-case scenario they envision?
Well, the central theme of the bull case, according to Morningstar, revolves around Tesla's potential to fundamentally reshape both the automotive and the energy industries through their integrated approach across electric vehicles, autonomous driving, battery technology, and solar energy.
Right.
There is a strong expectation of significantly improved profit margins in the future, driven by those anticipated breakthroughs in manufacturing cost reductions and the high margin revenue potential of their full self-driving software.
That's the upside. What about the flip side? What are the key concerns and risks that the bears are pointing to that could derail Tesla's ambitions?
The bear case raises several significant concerns. Firstly, the increasingly crowded EV market, with both established automakers and a wave of new companies entering the fray.
Yeah, competition's heating up.
Exactly. That could lead to slower sales growth for Tesla and potentially force them to engage in price wars, which would inevitably squeeze their profit margins. Secondly, the enormous investments they're making in developing autonomous driving technology might not yield the expected returns, potentially becoming what's termed value destructive if the robo-taxi tech faces significant delays or encounters fierce competition from the likes of Waymo.
That's a big gamble.
It is. And a particularly noteworthy risk highlighted is the potential for CEO Elon Musk's political activities to negatively impact consumer sentiment and demand for Tesla products in key markets like the US and Europe.
That last point about Musk's political activities is definitely a recurring theme in discussions around Tesla. Now let's talk about a crucial concept for any company's long-term viability. Its economic moat. How does Morningstar assess Tesla's defensibility against competitors?
Morningstar awards Tesla a narrow economic moat.
Narrow.
Okay. What this means is that they believe Tesla possesses certain competitive advantages that are likely to allow them to generate above-average returns on their invested capital for at least the next decade.
Right.
This moat primarily stems from two key sources. The first is their intangible assets, most notably their exceptionally strong brand image. Being perceived as a leader in luxury EVs and cutting-edge tech allows them to command premium prices and generate strong demand for their new vehicles, like the upcoming affordable SUV.
And they do that without much traditional advertising, right?
Exactly. It's quite remarkable. They've achieved this with remarkably little spending on traditional ads. This brand strength even extends to their energy storage business. The second source of their narrow moat is their cost advantage in EV production. Their significant manufacturing scale has enabled them to substantially reduce the average cost of producing each vehicle. They anticipate that these cost advantages will continue to be a key differentiator compared to legacy automakers.
So, a narrow moat suggests they have some real strengths, but perhaps not the kind of unassailable advantages that would guarantee dominance for decades to come.
Precisely. The narrow rating reflects a degree of uncertainty in the longer term, particularly beyond that 10-year horizon. The rapid pace of innovation in areas like autonomous vehicle technology could fundamentally reshape the automotive landscape, potentially creating new competitive dynamics that are difficult to predict right now.
Makes sense.
That's why Morningstar doesn't currently believe they possess a wide moat, which would indicate a much higher degree of confidence in sustained competitive advantages for over 20 years.
Let's circle back to that fair value estimate of $250. What are the key drivers of profitability that underpin that valuation? What are the crucial assumptions they're making?
Okay, so that $250 fair value estimate is derived from a discounted cash flow model, which essentially projects Tesla's future free cash flows and discounts them back to the present using a weighted average cost of capital of just under 9%.
Right, the DCF model.
Yeah. Looking at their recent performance, Tesla's vehicle deliveries in 2024 were actually slightly lower than in 2023. For 2025, Morningstar actually forecasts a further slight decline in deliveries.
Oh, interesting. Why is that?
This is partly due to the ongoing production ramp-up of the refreshed Model Y and the anticipated launch of their new, more affordable vehicle around the middle of the year, kind of a transition period. In the near term, they expect Tesla's automotive gross profit margins, excluding those regulatory credits they earn.
Right, the ZEV credits.
Exactly. Excluding those, they expect margins to remain in the mid-teens, which is below Tesla's stated long-term target of 20%.
And what about their expectations for the longer term, the assumptions that really drive that valuation over the next decade?
Looking out to 2030, Morningstar's base case scenario projects roughly 4.6 million vehicle deliveries annually. Now, while this is a significant jump from current numbers, it's considerably lower than Tesla management's very ambitious goal of 20 million.
Yeah, 20 million is a lot.
It is. Their forecast assumes moderate growth for the Model 3 and Y, the Cybertruck reaching around 50,000 units per year, and the new affordable SUV eventually outselling the Model 3 and Y combined, given its lower price point and wider market appeal.
Okay.
They also anticipate continued progress in reducing manufacturing costs, leading to a recovery in their automotive gross profit margins to the low 20% range. Crucially, their model also factors in increasing revenue and profitability from their autonomous driving software subscriptions, their insurance business, and the continued expansion of their supercharging network.
So service is becoming more important.
Very much so. They're projecting substantial annual revenue growth in their energy generation and storage division, driven by the growing demand for battery storage solutions, and they expect this segment to become profitable, with margins in line with its competitors. They also foresee overhead expenses decreasing as a percentage of their overall sales due to operating leverage as the company scales. This all leads to a projected company-wide operating margin in the mid-teens by the end of the decade.
It sounds like a significant portion of that future value is tied to these newer ventures like robo-taxes and their artificial intelligence initiatives. How are those factored into this $250 estimate?
Absolutely. Their base case includes a present value for the potential robo-taxi business, which they estimate at around $65 per share.
$65 just for robo-taxes.
Yeah, per share in their valuation. Additionally, the combined potential of their Dojo AI training program and their Optimus humanoid robot project contributes roughly another $20 per share to that $250 valuation.
Wow.
They anticipate that Tesla's robotaxi service could begin to enter the ride-hailing market by 2028, with a gradual rollout similar to what we've seen from companies like Waymo and existing ride-sharing platforms.
And as with any forecast, there's a range of possible outcomes.
Yeah.
What are the downside and upside scenarios that Morningstar considered in their analysis?
Right, the range is wide. In their downside scenario, which results in a fair value estimate of just $100 per share.
Oh.
Yeah. They envision significantly lower vehicle deliveries, a failure to achieve substantial cost reductions in manufacturing, and ongoing pressure on vehicle prices due to intense competition. This pessimistic outlook also assumes that their autonomous driving software doesn't generate significant revenue and that their insurance business grows at a much slower pace, with essentially no meaningful value derived from those newer, more speculative ventures like robotaxis.
So Basically, things just don't pan out as hoped.
Pretty much. Conversely, their upside scenario, which leads to a much higher fair value of $500 per share.
Okay, that's a big swing.
Huge swing. It assumes significantly higher than projected vehicle deliveries, greater and faster cost reductions in manufacturing, rapid and widespread adoption of their autonomous driving and insurance offerings, and a highly successful and widely adopted robotaxi service, potentially even including significant contributions from their humanoid robots.
That really gives you a sense of the potential volatility and the wide range of possible futures for Tesla. Now, you mentioned that Morningstar assigns Tesla a very high uncertainty rating. What are the key risks and uncertainties that contribute to this assessment?
That very high uncertainty rating reflects the significant number of moving parts and the wide range of potential outcomes we've just discussed. The report highlights the inherent cyclicality of the automotive market as a major risk factor.
Always a factor in auto stocks.
Always. Along with that intensifying competition in the electric vehicle space, which could put sustained pressure on pricing and profitability. The potential for CEO Elon Musk's political activities to negatively impact consumer perception and brand loyalty is also flagged as a considerable risk.
Yeah, that keeps coming up.
It does. Furthermore, the substantial investments they are making in research and development for autonomous driving come with no guarantee of a successful and timely return. They also point out a financial risk related to Elon Musk's practice of using his Tesla stock as collateral for personal loans. Finally, they touch upon various environmental, social, and governance (ESG) risks, including the potential for product defects and recalls, particularly related to their autonomous driving systems, the challenge of retaining key employees, especially given Musk's sometimes controversial public persona.
Right, the key person risk.
Exactly. Plus, the potential for patent litigation in a rapidly evolving technological landscape and ongoing regulatory challenges in some U.S. states regarding their direct-to-consumer sales model.
It certainly sounds like there are a lot of factors that could swing things in either direction for Tesla. Let's talk about how Tesla manages its money. What's Morningstar's take on their capital allocation strategy?
This is an area where Morningstar gives Tesla a very positive assessment, awarding them an exemplary capital allocation rating.
Exemplary, okay. That's strong.
It is. They highlight Tesla's strong balance sheet, with their cash reserves exceeding their outstanding debt. They also commend their significant and strategic investments in expanding their production capacity through new gigafactories, which aligns with the strong demand for their vehicles and their focus on driving down production costs, particularly through their in-house battery manufacturing initiatives.
So investing heavily back into the business.
Precisely. While Tesla currently doesn't pay dividends or engage in share buybacks, their preference for reinvesting their capital internally to fund their ambitious growth plans is seen as a prudent approach at this stage. However, the report suggests that future share repurchases to offset dilution from stock-based compensation could be considered once the production of their affordable vehicle ramps up and they begin to generate more substantial excess cash flow.
Interesting.
The report also touches briefly on Elon Musk's past compensation package and the recent legal ruling against it, noting a preference for future executive compensation structures to include metrics tied to return on invested capital.
So they're prioritizing growth and reinvestment, which is generally seen as a positive sign for a company in their stage of development. Now, you mentioned some recent analyst notes that shed light on more immediate developments. What were some of the key takeaways from those?
Yes, there have been several notable updates. The regulatory approval for their full self-driving software in China, announced on March 24, 2025, was seen as a positive step, potentially reducing the risk of Chinese consumers opting for competitor vehicles with more advanced autonomous driving features.
But will people pay for it there?
That's the question the analyst note raises. Will consumers in China be willing to pay a subscription fee for Tesla's FSD when domestic competitors like BYD already offer sophisticated Level 2 driver assistance systems for free? It's a valid point.
True. What else?
Then there was CEO Musk's company-wide meeting on March 21st, where he reiterated the company's strong focus on AI and robotics, while also emphasizing the need to increase vehicle deliveries in the near term, particularly with the ramp-up of the new Model Y.
Trying to calm the market, maybe.
Seems likely. He acknowledged the recent negative market sentiment stemming from lower-than-expected early 2025 delivery numbers and aimed to reassure investors of his continued commitment to Tesla, despite his increasing political involvement, while also highlighting the company's focus on vehicle quality and customer experience.
Okay.
He also discussed the rollout of their faster V4 superchargers and the ambitious plan to produce 5,000 humanoid robots in 2025, initially for use in their factories.
Humanoid robots, wow.
Yeah.
And the Cybertruck recall.
Yeah, on March 20th, there was a recall announced for the Cybertruck due to a potentially detaching exterior panel. This was viewed as a fairly common occurrence for newly launched vehicles and not expected to have a significant negative impact on the brand or delivery numbers.
Okay, teething problems.
Pretty much. Other analyst notes highlighted broader electric vehicle market trends, forecasting continued strong growth leading up to 2030, which could put upward pressure on lithium prices, with Tesla identified as a top OEM pick in this growing market. There was also an autonomous vehicle ride-hailing forecast projecting that robotaxis could account for as much as 50% of ride-hailing trips in the US and Canada by 2035, with Waymo and Tesla positioned as key players.
The robo-taxi race.
Exactly. Finally, a note on a stock plunge on delivery fears around March 10th discussed the market's negative reaction to an analyst downgrade and concerns about Tesla's 2025 delivery outlook, although Morningstar maintained its fair value estimate, characterizing Q1 2025 as a transition period due to the new Model Y launch and the anticipated arrival of the more affordable vehicle later in the year.
It sounds like there's a constant stream of news and developments impacting Tesla's outlook. Finally, the Morningstar report includes a comparison with some of Tesla's more traditional automotive competitors, Ford, BMW, and Volkswagen. What were some of the key differences highlighted in that comparison?
What's particularly insightful here is that, according to the report's data from late March 2025, both Ford, BMW, and Volkswagen were trading below Morningstar's estimated fair value, suggesting they were considered undervalued by the market at that time.
Unlike Tesla.
Right, in contrast to Tesla, which was trading slightly above its fair value. There were also significant differences in their economic moat assessments. While Tesla was assigned a narrow moat, none of these three established automakers were deemed to possess any economic moat by Morningstar.
No moat for the legacy guys. Interesting.
Yeah. The capital allocation ratings also varied considerably, with Ford and BMW receiving a standard rating, while Volkswagen was given a poor rating compared to Tesla's exemplary rating. Naturally, their overall Morningstar star ratings also differed, reflecting these various assessments of valuation and competitive strength.
And ESG.
And when it comes to ESG risk ratings, Tesla received a medium rating, similar to Ford, but with a lower exposure score, suggesting a potentially lower magnitude of ESG-related risks compared to Ford, for example.
So it paints a clear picture of the market viewing Tesla through a very different lens compared to these more traditional players in the automotive industry.
Exactly. Despite facing increasing competition and a high degree of uncertainty, the market continues to assign a significant premium to Tesla's growth potential and technological innovations, even as some of its more established rivals are seen as trading at a discount to their intrinsic value.
Well, this has been an incredibly comprehensive deep dive into this Tesla report. To bring it all together for you, it seems Tesla is a truly unique and dynamic company, navigating a period of rapid change in both the automotive and energy sectors. While currently considered fairly valued by Morningstar's analysis, its future trajectory is subject to a wide array of uncertainties, from the intensity of competition and the pace of technological advancements to the impact of global events and the leadership of Elon Musk.
For me, some of the real aha moments were understanding the seemingly counterintuitive impact of those potential U.S. tariffs, grasping the sheer scale and ambition of their ventures into robotaxis and humanoid robots, and, recognizing the ongoing tension between Tesla's undeniable technological edge and the growing competitive pressures they face from all sides.
And on that note, here's a final thought for you to really chew on. Considering Tesla's current position and these long-term forecasts, what single factor do you believe will ultimately be the most critical determinant of its success over the next decade? Will it be their continued technological dominance, their ability to scale manufacturing efficiently and cost-effectively, or perhaps an entirely unforeseen disruption in the market? It's worth considering the intricate interplay of all these elements and continuing your own exploration. Hopefully, this deep dive has provided you with a much clearer and more nuanced understanding of the key insights contained within these Tesla reports.